Welcome to the CFA Society India podcast, where society members engage in conversations with industry experts to bring you unique insights. This podcast represents the views and opinions of the originally featured speaker and is posted with their express consent. The podcast is meant for educational purposes only. It should not be construed as research, recommendation, solicitation, or investment advice by CFA Society India.
This episode is from the CFA Society India archives.
Now, let's dive into today's episode.
Okay, so good afternoon, everyone. It's widely considered that the post-lunch session is one of the most challenging. People would have had their filling, and after already 2 to 3 hours of engrossed knowledge absorption, and thereafter some food going in, there's a tendency to feel a bit relaxed. So that the relaxation can be rejuvenated, we have a very power-packed panel. The topic is Indian Equities, Golden Decade in the Global Reset. And it is my great pleasure to invite Mr. Nimesh Shah, Associate Executive Director, CNBC TV18, to moderate the session. So, Mr. Nimesh Shah, the floor is yours, and please get the panelists on the dais and let's get started with. Thank you so much.
Thank you. And as you rightly pointed out, it's going to be a big challenging, first session after lunch. So I'll try and see if I can make it as entertaining as it's possible. So the first guest on my dais today is Manisha Girotra, CEO of Manisha India. Please, Manisha, if you can join us. She's an ace investment banker and over 30 years of experience. So it'll be a very interesting session with her as well on M&As. So that's my first guest. Second guest is Rajeev Thakkar, the CIO at Parag Mutual Fund. He's been part of the Wizard series, so another ace market expert. So he's joining us. The next is Shibani Kurian. She's senior EVP and fund manager and head of research for Kotak Mahindra Mutual Fund. Shivani, please join us. And Sunil Singhania, the founder of Abacus. He's been a veteran in market investor, and actually he's been a mentor for a lot of people, including me. So it's a pleasure to share the dais with you, Sunil. Thank you very much. Thank you all.
Please your mic, I think.
It's not clear. Okay. I guess all are ready. Yeah, I think the audience is also ready. Let me start. So again, the whole theme is the Great Reset, and is this going to be India's decade? I personally believe this is going to be a golden decade for India. Let me ask the panelists as well if they believe that, and if that's so, what are the themes that they'll be betting on? So that's the first segment. Then we'll go ahead and debate further. So let me start with Sunil first. Sunil, is this going to be the India's golden decade? That's the big question that everybody has in mind. You've been a ace market expert for the last 30 years now. What is your sense? Are we in an inflection point as a country, as an equity market, that next 10 years is going to be a golden decade for India?
Thank you, CFA Society, for having me, and wishes of a great 2023 to every one of you. First a disclaimer, I've always been very optimistic on India. So please take my views with a pinch of salt. I've always been very positive, and I continue to be. In terms of your question, I think, it's very simple. See, we got our independence in 1947. Took us 60 years. By 2007, we had reached $1 trillion in economy. The next trillion happened in 8 years. And the third trillion happened in less than 7 years. So in the 75th year of this Amrit Mahotsav and 75 years of independence, India is $3 trillion in economy. Now, I am super bullish. I feel that this 3 will become 6 in 6 to 7 more years. If someone is bearish, he or she will feel it will become in 8 years. So there is no question that we are going to double from 3 to 6. If you are bullish, it will happen in 6 to 7 years. If you're not bullish, it will happen in 8 years. So the wealth which we have created in the last 75 years, exactly the same wealth will be created in the next 7 to 8 years.
Wow, that's a
No.
really...
I think a lot of people वो बोलते हैं बोले रह गए हम लोग, कुछ रह नहीं गए अभी तो. आई थिंक व्हाट यू हैव नॉट मेड इन द लास्ट 75 years, that kind of wealth is going to be made in the next 7-8 years. So obviously, I am very positive, and I definitely believe that we are in that hockey curve where we are going to grow faster than any other economy in the world.
Okay. Let me quickly ask all three of you all one line each on, do you all believe that this is going to be India's decade? And then I'm going to ask you about specific themes and how one should invest or play this decade if it's going to be indeed a golden decade. Shivani, first with you.
Yeah, hi. Good afternoon, everyone. So yeah, I think I'm in Sunil's camp because I do believe that going forward, the way India is structurally placed, all the ingredients are in position. So whether you look at incremental capacity utilization levels peaking out, or you look at financialization of savings and the entire financial services sector, and that adding to the overall growth of the economy, I do believe that from here, from a 3 trillion to a 5 trillion to a 7 trillion economy, the road map is clearly in place. It's a matter of execution and executing well.
Rajiv, what about you? Same camp?
So each time we have been very excited, things have gone wrong. So people may remember the BRICS narrative that was there in the past. So I'll hedge my bets, I'll say I don't know.
Achha, okay. Sure. Manisha, what about you?
No, I think I go in the camp of Sunil and Shibani because I think, the last 10, 15 years, the kind of structural reforms we've taken, whether it's demonetization, GST, using technology as an inclusive mechanism of really getting all individuals, all corporates into the formal sector, I think is now yielding results. When I started my career, we used to do incremental reforms like FDI and telecom going up from 26% to 49%. And, we as bankers would go everywhere and say, yes, yes, please come into our country. Now, we didn't do incremental reforms. We did drastic reforms which had pain, which weren't yielding the kind of results they should have, whether it's RERA, et cetera, et cetera. But I think now this is the time when those tough reforms, along with the fact that we have the favorable demographics, et cetera, which we'll talk about, will yield positive results. So I remain very positive. I'm not sure I'm as optimistic as Sunil, but look, I'm halfway there. I'm halfway between Rajiv and Sunil.
Okay. Rajiv, since you're in a minority camp, let me start with you. One, why you feel, why you're a little less optimistic, and two, what is the roadmap for India? What are the big themes that you are watching out for, which are going to pan out in the next couple of years?
Sure. So I said I don't know. I was not negative. So I am a person who is in the ignorant camp rather than the opposite camp.
Okay.
Reason why I am a bit circumspect is people can probably after this session Google up something which is correlation between GDP growth of a country and stock market returns. Okay. It may surprise a lot of people. It's 0 to negative. Okay. And it's done by a reputed investment bank across markets across various decades. It's not a short span of time. So we have seen China being a high growth country and stock market hasn't been really that good. And let's talk about sectors. So private civil aviation and telecom have been great contributors to Indian GDP, but they haven't delivered too much for the investors. Also, increasingly, I am in the camp that sees investing as a global pursuit. So if you are buying a Tata Motors in India, you are one way or the other buying Jaguar Land Rover. And if you are buying a Suzuki in Japan, you are buying Maruti in India effectively. And whether it be IT services, there's no difference between a Wipro, Infosys, TCS or a Accenture, Cognizant or ONGC does not get extra profitability just because they are in India. They are subject to the same oil prices that ExxonMobil is subject to. So I am not that excited only by the fact that our GDP could be growing. I am more in the camp which looks at unit economics very closely.
Okay. I'm going to discuss themes with all three of you, all four of you all. Let me start with Shivani first, because your theme was financialization and the way actually we are seeing this, right? For the last 10 years, we're seeing a lot of transformation happening. Today, with UPI, we can do so much of payments. It's the most downloaded app. The most transactions happen through UPI now. Do you believe that there is still a lot of this potential, financialization is pending, or it's already been done? So what's your view, and why you're still betting on financial as a theme for the next 10 years?
Sure. So, I'm sitting between Sunil and Rajiv. And one hand, we are talking about GDP growth, and on the other hand, we are talking about unit economics. And for me, the financial services space is an epitome of both. So on one hand, when you talk about the entire financial services sector, the sector obviously derives from the inherent GDP growth of the country. And also, if you look at the share of profit pool of corporate India or the overall markets, financial services has contributed significantly, which is why today, in terms of its proportion in the index, the weight is the highest. And that's a reflection of profit pool growth that you've seen in the sector as a whole. So, when we talk about financialization of savings, we know that the story of the entire savings pool moving from physical assets to financial assets over the last 5-year period has been taking place, and it's there in numbers. What's also important to note is that within the financial savings pool, obviously deposits have been the largest portion and still contribute about 40%. But in the last 5 years, while deposits have grown at 10% CAGR, the investment universe or the investment side or mutual funds, insurance as a financial savings pool has grown at 16% CAGR. And therefore, there are three aspects to it. One, the correlation to GDP. Second is the under-penetration story, where you look at whether banks, whether you look at mutual fund, the industry I belong to, insurance, general insurance, or even segments such as capital markets. The under-penetration story is there because the numbers are clearly showing that vis-a-vis world averages, we are still a long, long way to go. The third aspect, as you rightly pointed out, is the technology and financial intermediation, which is now helping in terms of bringing these products out of the metros and the larger cities into tier 2, tier 3 segments. For mutual funds as an industry, what we are now incrementally seeing is a lot of growth is coming from the B30 cities, and therefore that is an epitome or a signal about the financial intermediation and technology helping in terms of growth.
Sure. But Sunil, I want to take that Shibani's point forward and ask you, while we're all talking about financialization, digitalization, and the big benefits of that, it also means a lot of disruption as well, right? A lot of traditional businesses are getting disrupted. A lot of businesses may not be even in existence in the next 10 years from now. From that point of view, what are the key risks that you foresee in the financial space, largely from a disruption point of view because of digitalization?
See, there is absolutely no doubt about what Shibani said. And, actually, if you see our daily routine, we now can't live without any kind of digitization, whatever you do, whether it's a bank transaction, it's a payment, it's, whatever it is. And I think to some extent, it is also adding to the efficiency of the entire country. And this 20% growth in tax collections is not only because we are growing fast, we are growing only at 6.5%, 7%. It's also because of higher compliance because of this digitization. So when disruptions happen, there are some disruptions which impact negatively to few companies, and then there are disruptions which impact positively to new companies. I think there is absolutely no doubt. In fact, in our framework, MEETS framework, we have one E, which is events, trends, and disruptions. I think disruptions will hit not only on the digitization side, but in multiple businesses. Right. The way we work, the way we study, the way we shop, the way we entertain ourselves is completely changed. Gone are the days where you could buy anything for 20 years and forget about it, because that company or sector might not last beyond that even 10, 20 years. So even in digitization, I think it has led to obviously headwinds for a lot of companies, but it has also provided the forward-looking companies with added business opportunities. So mutual funds, for example, because of digitization, the KYC and all, it's so easy to open a broking account. It is so easy to open a mutual fund account. Earlier, I remember when I was on the mutual fund side, we did an NFO and we got some 16 lakh application. It took us 2 months to process those applications. Now it's all online. So I think digitization for a forward-looking company will be great opportunity. For a company which is going to be like Kodak and say that, if I launch a digital camera, it will impact my film business and then die. I think for a company which is not forward-looking, it would be a Kodak moment.
Manisha, what's your take on this whole digitalization and the fact that there are some sectors who are going to benefit, but also there's going to be a disruption for a lot of sectors? You've been an investment banker. You've seen so many companies, doing well, also doing bad or going bankrupt. How are you seeing the changes which are happening both globally and in India, and the potential impact that can have on many of the sectors and companies?
So look, that's a very relevant question. If you ask me what is it that India should focus on in the next 10 years, it's exactly this, that the fact that business models are just getting disrupted, right? Things that we did traditionally, as Sunil said, we don't do anymore. The younger children are studying in such different ways. My daughter's in college and she had this big assignment And 1 hour later, she called me and she said, it's done. So I said, how did you do it? She said, I didn't do it. ChatGPT did it. And I was like, ChatGPT did your whole project? She's like, yeah, it does everything. So, you and I would never have thought about it. We were sat through copiously, had a nervous breakdown, had 6 cups of coffee and probably done that assignment overnight. But so things are changing rapidly. And I think that's what India needs to focus on. We've used technology as a pivot to really inculcate the structural reforms that we talked about. We now need to do it to basically create job scalability, upgradation of jobs, right? Because jobs in the traditional sector don't exist. It's been taken over by machines, whether it's in the traditional manufacturing services sector. We need to have more productivity, modern sector-linked jobs. We need to get women into the workforce. And, hopefully the COVID taught us that, you can have flexible hours, get more women into the workforce. Reports have shown, just getting women into the workforce would increase GDP by $700 billion. We need to rethink the way that we are going to use our workforce, because in the digital economy, your biggest asset is your people. But it can be the biggest liability too, right? Because, if they're not upskilled, reskilled, then you don't know what to do with that workforce. We have proved to the world that we can be the office to the world, but we're trying now to be the factory to the world. And for that, we must upgrade ourselves. And I would think that is the biggest challenge for India to sustain what we have done through the difficult period. We need to now, go through the next level of reforms in people. And that's not just Make in India, etc. It's corporates, individuals, everyone needs to upgrade, reskill and upskill.
Rajiv, coming to you, you have a very interesting theme that you shared with me off record as well. A decadal mean reversion, basically, some neglected sectors which nobody's looking at, one should look at now, and also avoid some of the overhyped sectors. If you can just briefly tell us what your thesis is all about, and then I'll take it forward.
So I started my career in early to mid 90s, and since then till date, barring short reversals, we have seen interest rates coming down over a period of time. And since maybe mid 2003, we have seen valuations in equities just go on going up. So I know Sunil has also pushed back against this buy at any price kind of concept for quality companies. So what we have seen is where interest rates are very close to zero, it doesn't matter whether the profit comes this year or profit comes after 10 years. If your discounting rate is zero, it doesn't matter any which ways. So at one end, we have had this whole excess valuation in the quality basket, so-called quality basket. They are great companies, great management, but maybe not great investment. So that I think is poised for mean reversion when the world is moving towards a positive real interest rate scenario. The other space, and we spoke about disruption and digitalization, and which is great if it improves efficiencies for the customer or improves turnaround time and so on. But for a lot of people, digitalization has been all about blowing up money in customer acquisition costs and saying, we'll make it up in volume. So on each unit, they actually incur a loss. And some people have called it a urban consumer subsidy scheme by venture capitalists. So it's been almost like a philanthropic effort by these foreigners who have worked towards making the yuppies in India rich. So I think that is coming to an end. We have seen some of the newer listings fall in valuations, and there has been a big pushback against some of the DRHPs that have been filed. So I think that could be going towards mean reversion in 2023, where people are saying, show us the profits, show us the path to profitability, rather than just saying, we will provide a consumer subsidy and show revenues.
Sure.
At the same time, there are some sectors which have had maybe a couple of decades of underperformance, and there have been plenty of false starts. So I'll caveat when I speak about this sector. So in 2002, 2003, there was this move towards privatization, and at that time we had a few of those, so Hindustan Zinc and Modern Foods and some of the hotel assets. But then again, it stalled somewhere. We have just come out from the privatization of Air India, which was spoken about for a long period of time. So we have these huge set of companies which are undervalued in terms of their asset valuation or in terms of the network that they have, but they are not run as a business. And investors have been pushing back against the governance practices. But if those PSU privatizations start coming back, I think you could end up making a decent amount of returns. But it has its associated risks in terms of a false start happening. The other space that we are looking at is when everyone is excited about renewable energy, that is some time away. That is the future, but in the near term, I think the traditional energy has seen a lot of underinvestment, and I think that traditional energy will ironically be needed to create that the renewable energy infrastructure. So that is one space which looks neglected right now.
Shivani spoke about it's going to be a bottoms-up market, and nobody can be better than you in terms of identifying the right sector and the right stocks. I can already see some people joining, so let's make it a little more exciting. Give us some idea about how should one approach this market, if it's going to be a stock-specific market or bottoms-up market. What are the key trades that one should watch out for?
So, I think investment is all about actually stock picking. It's not that only in mid-cap or small-cap you pick stocks. Even in large caps, if you see the disparity in returns within the same sector, the blue-eyed boy of financial services is down 25-26% in 22. Vis-a-vis other banks are up anywhere between 30 to 100%. Yeah. So, just because you are in the same sector, all the companies will perform in the same way, I don't think it is true. I'm a proponent of value-conscious investing. I won't say that value investing, but value-conscious investing. And therefore, from time to time, you always get these opportunities. Sometimes you are lucky, you are able to latch on to them. Sometimes you are not as lucky, but it is fine, पूरी जहाँ का पैसा हमको ही थोड़ी कमाना है, सबको कमाने दो थोड़ा-थोड़ा. But having said that, I think the good thing about India is that we are a very entrepreneur-driven country. We are like to some extent North America. So many thousands and millions and crores of entrepreneurs. And I think that is what makes the country resilient and interesting also. And so is the market. And the other thing is, when an economy grows from 2 trillion to 3 trillion and 3 trillion to 6 trillion, there will be so many exciting new businesses which will come up. Now, the new age businesses, whether investors made money or not, but hats off to them for creating a business, whether it's Zomato or Swiggy of delivering, your parcels to your home, and so many other, Paytm also, we can't live without UPI and all these apps. So they've created great businesses, and I think that is going to be an opportunity going forward. We invested in a company last year which is into lounge management at airports. I didn't even know whether that kind of concept existed. We have a wine company which has got listed. We have a Mercedes dealer which has got listed. So there are so many opportunities which are coming up. So I think opportunities are going to be multifold. One thing which I believe at least, and we at Abacus follow, is we say no to no sectors. So actually, if you see we have made more money in a steel company than we made in a digital company. So every sector at some point of time becomes exciting. That is what our view is. And very simply, there are only three things one should follow according to us. One is company makes profit. Second is company has visible profit growth. And third is like a pakka marwadi, which I am. What you pay today should be more than repaid to you by way of future profitability. Right. I think as long as you are able to do this, everything is fine. There are great companies which are there. The BAP, like the buy at any price, which I am not a proponent of. But you can't buy a 10% growth company at 80-90p. Every day, people say growth stocks. So even today, I was just talking to my daughter and I was just telling her growth, and she said, what's the definition of growth stock? What is the definition of a growth stock? Growth stock is something which grows significantly higher than the GDP growth. Our growth stocks in India, which are classified as growth stocks, are not even growing in line with the GDP stocks. So just because someone says it's a growth stock, don't latch into it. Just because someone says that this is cyclical, don't get trapped into it. I think be open. At least that is what our belief is. And as I said, India presents so many opportunities. I can't name stocks here. And I would just end by saying that, if you get into something which is working well, don't be in a hurry to sell. So rather than focusing on what to buy, the two biggest mistakes I have made in my life is Bajaj Finance and Eicher Motor, both of which I own 9%, and both of which I tripled my money and sold very early. And after that, they became 50x from there also. So, just because something has moved, don't be in a hurry to sell.
That's a great thing, Sunil. Actually, this is something you taught me as well. When we when you spoke on air. Rajiv, coming to you now, there is a lot of audience who might be interested in knowing what's happening with the Nasdaq tech companies. You've been an owner of a lot of these, internet companies, Meta, Apple, Microsoft. Tell us, what is the trade-off between those stocks right now after the correction, and what could be the trade-off for Indian companies right now at the valuation that they're trading on? Briefly, what's your sense? Where you will think which can do better in 23?
Rather than getting into which is better, I'll describe what those companies do and where
why
the
you're bullish,
opportunity set is. So the underlying trends, which were pre-existing COVID, continue today. In COVID, they got massively accelerated. 22, they took a pause. But the underlying themes are the same, and I think everyone can agree on this. There is preference towards cloud computing versus on-premise servers. There is preference to watch streaming content like Netflix or YouTube versus linear TV channels. There is preference towards digital advertising and social media, e-commerce versus physical stores. So all those underlying trends are still there. These companies revive memories of the late 90s and the dot-com boom and bust, and that is where people are drawing parallels today. But these companies today are very, very profitable on traditional metrics. You look at sales, you look at cash flow, profitability. So I don't think this time the fall is similar to that what we saw in late 90s. Sure, some segment of the Nasdaq stocks have been overhyped and have been betting on this future disruption without current cash flows. But I think the larger companies are in a different league. And today when India digitized because of Geo and the cheap data plans that we have, some of the biggest beneficiaries have been these kind of companies. So just as a data point, let's say a company like Meta, which is Facebook, would be reaching some 350 crore people globally, which is bigger than the biggest countries. And you can advertise with proper segmentation by time of day, gender, location, interests, various targeting parameters. So I don't think those advantages have gone away. I would look at the correction as an opportunity to invest if someone can.
Before I open the floor for audience to ask some questions, I've got some questions already. I'll check those. But I just want to have a quick rapid fire with all four of you all. I'll just ask three, simple questions. Honestly, you can answer those. Sunil, should I start with you? Okay. I know you've been a big fan of small and mid-cap companies, and that's where you've created a lot of wealth for investors as well. First, if I want to ask you today, you'll bet on small cap or a large cap in 2023, what would you answer?
So, always if you have a 3-5 year view, small caps is the way to go. Can I just take a minute?
Sure.
See, when you have limited sums of money, which I started with when I started my career, you could buy only small caps. So that is how the journey started. But the thing is that in a growing economy, small caps tend to grow faster. Okay. But have a diversified portfolio. But if the risk-taking ability was like what I have, small caps is the way.
Okay. If I have to ask you to choose outside of equity, gold or real estate, what would be your preference?
None.
None. So fully 100% equity.
You have your own house, your office, and being a traditional Marwadi family, you have your, wife who keeps on buying some gold. But I haven't bought gold for investment. Like I don't have those gold bonds or gold bars or anything of that sort.
Sure. There are a lot of young participants here. From a degree point of view, a CFA degree or an MBA degree? What would you advise? I wanted to specifically ask you this.
So I think, being a very early proponent of CFA, when I did my CFA, I think I was among the first 10, 15. And I was the founder of the CFA Society, so it's very dear to me, and the course is very dear to me. CFA, I think, is an excellent add-on. I don't think any professional should do only CFA. So you do a CA CFA or you do an MBA CFA. You should not do only CFA because it's self-study. And I think, at least my view is that just having that experience of classroom training in an MBA and networking, that's a big plus. So I would say CFA should be an add-on.
Got it. Fine. Manisha, if I can ask you a few questions. So first, given a chance, would you like to become an investment banker again or a CEO of a listed company?
Investment banker anytime.
Anytime.
I just love this profession.
A true investment banker for the last 30 years.
Yeah, I think maybe I don't know anything else. This is all I do, so I'll stick with this.
Got it. For the next 10 years, if I want to ask you, US equities or Indian equities, what would you bet on?
Definitely Indian equities.
Indian equities.
You know, I think the growth that we are going to offer, of course, US has sustained itself and the Fed has been very smart about the way they're taming inflation, etc. But I think if you're looking for supernormal returns, they're not going to come out of the US, they're going to come out of India.
Okay. One company, according to, because you've helped so many companies go public and raise money, whatever, one company that you think will be the first company to hit $1 trillion market cap in India?
Hit $1 trillion market.
$1 trillion market cap.
Now you get me into trouble. I can't say this. All these are my clients.
No, it's a wild guess. I mean, you can just say any of the groups.
I guess Reliance maybe.
Okay, got it. Fine. Shivani, coming to you. For this year, what would be your preference? Equity scheme or a debt scheme? Or a debt mutual fund scheme?
I think still equities over debt because I think that overall, while we are debating a lot about earnings, valuations, etc., remember equities have given positive returns for 7 years, and that's history.
Yeah.
If it gives returns for the 8th year, we create history again, and I would bet that we possibly do create history once again.
Okay, got it. I can't ask stocks. I'm going to ask you to bet on a sector. IT with the worst performing sector of last year, or PSU Bank the best performing sector of last year? What would you bet on for 23?
Between the two, I would say IT. Because finally, for PSU banks, while obviously the sector itself has gone a lot of transformation, you move from loss to profits, your return ratios have improved and all of that. But still, if you look at the PSU banking pack, the challenges remain on capital. Also, ROAs are significantly lower than what peer group large private bank ROAs are. And therefore, the valuation catch-up, at least for the smaller PSU banks, seems to be now done. And therefore, between IT and PSU banks, my bet would be for IT. But you would still have to wait a little bit, maybe second half of the year for IT in terms of performance.
Okay. Lastly, in absolute terms for this year, Nifty negative or positive?
A tough one. But I would, like we were discussing, hopefully this will be the 8th year of positive returns for the Nifty. So, yeah.
Got it. Rajiv, coming to you. Apple or Infosys or any other IT companies for this year? What will you bet on?
I can't talk stock specific, but I think as a group, the big tech in US has been sold off quite a bit and is looking attractive.
Okay. So in fact, that was supposed to be my second question. Will you bet on NASDAQ or will you bet on Nifty for 23?
Both. So I'm not a proponent of this versus this. I've been advocating go where the individual opportunity is. So there was a discussion that this year is the year of bottom-up stock picking. I do only that. I'm not a macro investor. So one would choose stocks across markets wherever you find the opportunity.
Okay. I don't know whether you're a cricket fan or a football fan, but given a chance, you will watch a football final or a cricket final?
Cricket final.
Cricket final. You're a cricket. Great, sir. Thank you very much. All the four participants. You've been excellent in the rapid fire as well. I think I've lost the, where I can find the questions that you all have, the audience has put out. Can someone just help me?
Kabir hoga. Kabir.
Can just someone, there are some interesting questions too. So the first question, I think I've briefly read it. So Rajiv, it was to you basically. What is your view on US equities, and basically what is the regulation for Indian mutual funds, which to further increase their exposure into US stocks?
The second part is very easy to answer. There's been no update. So the industry limit has been frozen at $7 billion. Only to the extent people see redemptions, they are allowed to take fresh subscriptions. So there is status quo. We have to still hear from RBI and SEBI on this. US markets, I think, selectively is looking very attractive in some of the big tech names that we have seen a sell-off in.
Okay. Is there a mic that we can give to the audience if somebody wants to ask a question from the audience? Is there a mic there? Can you please, if somebody wants to ask any question to any of the panelists, please can raise your hand and ask the question. Here's the gentleman.
Is it on? Okay. Oh, hi guys. Hi Sunil, Shibani, Rajiv, Manisha. Quick question. Any book, video, blog, or article that you have read or watched which you liked, very much, but don't think that most people are aware of?
So in 22, I read the autobiography of Mr. Seksaria in terms of how he set up Ambuja. I think that was very interesting that I read in 22.
So there is a question for Sunil. You said, not to exit from winners so easily, so early. So the question is, what are the parameters that you look for when you look to exit a company or to decide to exit a company?
So I think after making multiple mistakes, and we keep on making more mistakes every day, I think the motto is not to repeat the mistakes. I think we have shortlisted 3 major reasons why we would sell a stock. So one is when your hypothesis seems to be not playing out the way you expected. And I'll give an example. We had a paper company which we had bought, which qualified all our parameters in terms of valuation, growth, and so on and so forth. And then COVID happened. And it lasted for a long time. We realized that no one is going to office, no one is going to schools. We were scared to even touch newspapers. So our whole hypothesis of growth in paper consumption went down, and we exited the company. Obviously, after that, there was a big jump in paper prices, but our hypothesis on growth in paper changed at that point of time. So one is when your hypothesis changes. Second is sometimes you buy a stock with a perspective that the stock over a period of time can grow X, and your price can be Y. Doesn't mean that the moment these two are reached, you sell it, but when it becomes like exorbitantly far beyond what he had thought, I think that is the second reason which we have very clearly articulated will sell. And third is capital is limited. So you have something which you like, but there is something else which you feel can be significantly better than what you already have. So it makes sense to switch because there's obviously this marginal utility of capital which you would like to extract. So these would be the 3 reasons.
Sure. Manisha, a question for you. Isn't 100% OFS a sign that the company is efficiently run and doesn't need capital? There's just some of the investors want to just exit. So what's your view on those companies? IPO, only OFS, nothing to the company, only for exit. What would be an advice to those companies? Do you think it's a sign of a good company who doesn't need capital?
Yeah, absolutely. As I said before, look, the fact that a lot of the offices have been secondary sales only, we shouldn't read too much into it because we as a market and economy are not used to such large secondary sell downs. I see it as a positive that secondary sell downs are happening. And if a company is well run, please look at the balance sheet. If it's efficiently run, isn't raising capital, that's a positive because the last thing you want is for the company to be sitting with cash on its balance sheet. It doesn't have any inorganic opportunities. It's just a drain, right? So I don't read negatively at all into companies which have secondary sell downs as IPOs or OFSs, etc.
Shivani, if I can ask you this question, does political climate matter if one has to look at a decadal view? And in that case, what are the leaders for the next decade which you think can emerge from climate change?
So you're talking about political climate?
So political climate change, and is that something that one needs to take into account when you're looking at 10-year view? And in that, what do you think could be the leaders who can emerge?
So when you're talking about the political climate of India, I think that, while at some point in time it does, closer to the elections, etc., there is a lot of talk about what the government policies, etc., will be. But I think one thing that has worked in India's favor has been that we are a democracy. And today, being a democracy means a lot in the global context. And therefore, that is what has helped India in terms of garnering a big share in terms of the portfolio flows that we have seen over a period of time. In terms of where we're looking at opportunities over the next, say, decade or so, I think our belief is that domestic facing sectors clearly are significantly better placed, significantly well placed. To give you an example, over the last maybe a decade, we have hardly seen any incremental private sector capex in India. Our belief is that we are on the cusp of change. Of course, we have been talking about private sector capex also for a while. But if you look at the data that is coming through from companies, industries where capacity utilization levels are significantly above long-term averages, and capital being available, companies having deleveraged balance sheets, I think the entire private sector capex story is actually at the cusp of breaking through. And therefore, the entire infrastructure, capital goods, manufacturing as a segment can be a big segment to look at from a theme over the next decade or so. The second we had already discussed, which was the entire financial services space. Again, both of them have linkages to domestic growth and domestic economy actually playing out.
Okay. The next question is for both Rajiv and Sunil. Both can answer or one of you can answer. In a scenario of higher interest rates and higher inflation, would you change your thought processes? Would you change your return expectations? Rajiv, first you go.
Okay. I think it changes things a bit when the rate change is very, very significant. So in an era of, let's say, 5-6% kind of interest rates, utilities, etc., start looking very attractive. But in a era where banks are paying 8% interest rates and corporate debt will probably creep up to 9-10 somewhere down the road, I think capital efficiency will come to the fore, which used to be the case earlier in high interest rate environments. Asset-light businesses will be preferred, I would think.
Sunil, your take?
Yeah, so one is, frankly, I've never been able to forecast either inflation or interest rates. And we don't even attempt to do that. I don't think even Fed is able to forecast. In fact, if you just do simple mathematics, by April, May 23, inflation in the US should be negative or even at least zero. And interest rate increases, which we are talking about, just going by general knowledge, not being a seasoned economist or anything, there should be murmurs of interest rate cuts towards the second half. So I think the world is very dynamic. I think no country is going to let interest rates go much beyond a particular level, and therefore we are of the opinion that this in the US maybe a 1-3% interest rate band, in India maybe a 6 to 7.5% band is what we have to play with. So we don't give too much of weightage as of now because we feel that these are transitionary. Like, it can happen in 6 months, it goes up, and 6 months it comes down. So it's very difficult to play. But I would agree with Rajiv that if the view is of a significant change, then you'll have to look at higher capital efficiency companies to bet on. Because if you see the past, post-Lehman, companies which had a high debt, they almost went belly up because their cost of servicing that debt just shot up through the roof.
Okay. I think I'll just ask one question. I think somebody is raising a hand. If I can ask.
Okay, thank you so much, sir.
Just one question. We are already. Just one question, please.
Yes, sir. One, it's a rather compound question. I was making it for the past 1-2 minutes. Pleasure meeting you. So my question is addressed mainly to Rajiv sir and Sunil ji. See, Sunil ji, you referred to value conscious investing, and Rajiv ji heading PPFAS, which by the way is the SIP I have invested in since the past 5 or 7 years. It's the only value theme based investor that I found. How do you identify value, and how can value investing help us find the next multi-baggers? I mean, we know the multi-baggers of these past 2 years, and they were not coming in anyone's model. 100p, 120p pe ja rahe wo. So how, but I want to be a value investor. So what are the factors that we should be looking at to identify, in general, very broad-based way, identify the next few investment opportunities over the next 2 to 3 years?
If he gives that mantra, you will not put money in his fund. So he might as well not say this. Yeah, Rajiv, boliye. So multi-bagger idea.
Just a minute is left. So see, don't go by labels. Ultimately, everyone is trying to buy something which is worth more than what you are paying for it. So if you are paying 100, obviously you don't think that the stock is worth 80. You think it's worth 150 or 200, whether you call it value investing, growth investing. And Buffett himself has said value and growth are joined at the hip. So growth has to factor in terms of the valuation that you calculate. So essentially, I don't think there's any significant difference between what Sunil spoke about or what we practice. Everyone is looking at paying less as compared to the intrinsic value, and then you stay invested.
All right.
The multi-baggers will come to know after 5 years.
Exactly.
So
Can't invest.
what became multi-baggers last 5 years, we are knowing now. The other thing is, what is the definition of a multi-bagger? 20x, 30x, 50x. The fund which I used to manage and which is then carried forward has grown 200x. So multi-baggers are created over a period of time by this eighth wonder which we call compounding. So this whole notion that I want to buy stock which doubles every year, you will end up buying some shit. So buy something which can continuously keep on generating returns, which after 10, 20 years would look like a multi-bagger.
So the best way to make money is put money into Abacus and put money into PPFS.
Don't forget Kotak Mutual Fund.
Thank you very much. Thank you.
Thank you for listening in to today's podcast. Before you go, please subscribe to stay updated on your favorite podcast app.